What's going on, everybody in the chat? axisALiVE here, joined today by Funding Jim. We're going to be talking a little bit about institutional adoption of HEX. We're going to be trying to encourage our Hexakin family to be smart about how they position themselves in the future, how they're going to get rid of their HEX at certain price points. And we just want to generally send this message of welcoming large investors to come into the space, and that, to remind both small and large investors that there's just so much opportunity here, and that scarce market supply does not mean a fallible market. Meaning, we're in this unique period of HEX history where there's a shortage of market supply. There might be 10 billion coins liquid, but nobody wants to sell them at these prices. And so you're really dealing with a 50 to 100 million HEX in the pools at any given time. And so the key here is as we welcome in, high net worths, institutions into the space, we need to be able to give them the tools to be able to read the market properly. And that's easy to do in HEX because 95% of the volume is traded on chain. All of the functions and actions occurring in the contract are on chain. So we can actually go and target and categorize specific wallets to their behaviors. We can measure the daily dollar payouts over time and see when conditions are where income is so insane people want to sell, or when income is so small in dollar terms that the price can just fly higher. And so, myself along with Crispy Man, Crypto Sloth, Silver the Antidote, we're trying to put together some sort of package for you guys as institutional clients that can help you guys understand the ecosystem better and give you something that you're more familiar with, as far as coming from legacy finance and having certain tools that you're and expectations of what you need in order to make knowledgeable execution of your investments, your trades, however you want to run your portfolios. So without further ado, I'm bringing on Mr. Funding Jim. He's joining me today from South America. So there's a little bit of a delay on the voice, but I'll try to keep contain my excitement so he has time to speak for once.
Thanks. Try to make sure that the microphone is okay for your audience before we get too deep into this. If they can say so, I'll either speak up louder or turn up my mic.
Yeah, please do it. And if same here. If you guys can hear me well, that's great. Just let me know. Sometimes this microphone gets a little glitchy.
All good. So the past few days I've been experimenting, and I think I should do the same thing that Richard is doing, which is upgrade brand and upgrade, both websites that might be out there, have been known, social media platforms, headers on Twitter and things like that. So the past, 2 days or so, starting to do a little bit of a rebrand myself. And it is because I engage very regularly, high net worth people in most of the crypto, most in the real estate space. But we end up talking about traditional finance. We're obviously the past couple of days, especially with Signature Bank, Silicon Valley Bank, people that participate in venture capital. There's a lot of turbulence there, and decision making from the Federal Reserve or government policy and things like that will be forthcoming. So that's a lot of the conversations recently. And in between live streaming some of the spaces that Twitter makes available to us, especially in the finance realm, I am doing that sort of upgrade. So I'm really happy that we're going to talk today about institutional high net worth, people that look at these things from a perspective above and beyond retail participation, and what they really think about cryptocurrency. Most of the content that I have heard, or when people say the word crypto, it is because of liquidity that's available in Bitcoin or liquidity that's available inside of Ethereum, and maybe retail and other investment grade investors, or large scale institutional grade investors will move the price, but they're not actively trading in and out there, but they do care about how much they push the price, either positively or negatively, when they enter or exit the market. So that's why they look at Bitcoin. And as much as we like price volatility and price go up and finding these new plateaus at a higher level, for our price ROI. They are interested in other people doing the work of price, and they want to enter and exit pretty much where they expect to. So I hope we talk about that a little bit today.
That sounds like a really good conversation. Yeah, to your point, it's important to remind, retail and grade investors, people that may have got into HEX when price was fractions of a cent, that saw this huge price appreciation, those were the early days. And that's kind of setting the trend for where price can go in the future. And so it's a double-edged sword for large investors because they don't want to risk volatility to the downside. They don't really need to risk volatility to the upside when they buy Bitcoin. And so we need to try to remind them of why the volatility, in either direction could be good and beneficial for them now at this particular point in the HEX life cycle. And I think one of the key things when we're talking about this is how if you're watching the HEX price chart right now on like a daily time frame or a weekly time frame, and you're comparing it to basically where HEX came from in the beginning, we came right off of a 96.5% drop in HEX, and that only happens rarely. It happens in the deepest, darkest of the bear markets. And in the case of both occurrences where we went 95% plus deep into the red, those were both instances where people had made, and when I say people, regular retail investors, not our big whales. Most of our big whales don't sell like that. Most of the people that are selling like that are people that came in with $20, $30, or $40,000 and were able to pull out $12 million in profits. Or as an example of one of these most recent sharks who created a somewhat short-term crash in price. And this is good because we want them to get out of the ecosystem now in massive profit as a good marketing piece to show what the system's capable of doing, but also in reminding you guys that there was only really one good chance to do a Bitcoin 2.0. This cryptocurrency basically sparked DeFi summer and created an entire bull run. This coin was launched at the bottom of the ETH bear market, and it helped usher in so much price appreciation and prosperity for the participants in it that now you have, by latching onto this ecosystem and getting exposure, you're leveraging one of the largest and most loud and prominent communities in cryptocurrencies and through social media and beyond. And Furu Finance says this very well, where he talks about how it's going to get to the point where HEX is synonymous with Bitcoin and its popularity, and you want to be front running that. You want to be recognizing that now and finding a safe and secure way to get exposure. And so that's kind of where this conversation piece will kind of lead into.
Yeah, I love it. I love it. We can talk, and we have for many years, about the volatility, but kind of up and to the right that HEX had from launch. There's a launch day, and then there was this perception that you had 20,000 ETH that went in, and then the next day it was 5,000 ETH. So there's a price speculation or association about the value per HEX. And then later there were other charting tools that were available as far as the climb and the popularity, and going from 20 participants to 200 to 2,000 to 200,000. So you saw the ramp basically of the networking effect for HEX specifically from 2019, 20, 21, 22. And now there's a maturity as far as popular phrases like the Lindy effect, that the code itself has been bulletproof, and the community has been had great resolve as far as continuing to stream and create content and educate masses about the hex on hex return built into the protocol itself. So it's really a stage of, like you said, the life cycle of cryptocurrencies, with the longest reference being Bitcoin, and the more recent references of Ethereum's growth through these cycles, growth and pause during bear. but continual new participants. Now, those two references of Bitcoin and Ethereum have pretty good depth, and they also benefit from cross marketing. So if I am enthusiastic about HEX, the protocol, it rides on the rail currently of Ethereum, and there is a liquidity bonding effect of being paired in that way, like the ETH HEX pair, or other things such as the stable coins of TUSD, which I like better, honestly, than USDC or DAI or some of these other liquidity kinds of stable coins. Those in the ecosystem of itself allow for us to promote the security model of the L1 in Ethereum and the endpoint of value, which is the protocol of HEX. Now we just need to basically to understand that better and relay the information better to institutional level or high net worth level participants in this marketplace.
I think the key thing here for large players when they're coming into this is to recognize the power that you're going to have when HEX is trading at dollars. And the first question would be like, well, how can you guarantee dollar price targets? And another question would be, what's the adoption rate and what's the users look like right now? And so we've seen like a consistent uptrend in users, even in the bear market. Like I think there's over 400,000 holders or close to there. And then there's like another 120,000 wallets staked. And that has done nothing but go up for years, right? And so then, there's already like a buzz around from ETH Genesis whales, like new big wallets that have tons of Ethereum that are already in crypto and have been in the game since the beginning of Ethereum in 2015 that are sitting on this bag of gold, that's going to be only going to be looking to do a 5x to an 8x in returns over the next, 3 to 4 years, this next cycle. Imagine their Ethereum bag goes from $1,500 roughly up to $8,000, or maybe you get a double on that to get to 16K per Ethereum. Even if you get there, there will be that blow off top or double top moment where it will then retrace. And so they're faced with this position of, do I sit on this? There's a lot of them. ETH whales sitting on tens of thousands or hundreds of thousands of ETH that are faced with this decision of, do I get exposure? Do I keep my Ethereum and just sit on that, or do I try to seek out returns somewhere else? And I think the natural inclination is going to be to take some of that portion of their wealth and put it into HEX. And just alone, if you get a few ETH whales to do that, it's going to take the price to the all-time high and way beyond. And I made a good case for this before in that, as far as the liquidity is concerned on these pairs, you have like roughly like 50 million to 100 million HEX sitting in the pools for purchase. And, there's people sitting on ETH with maybe like $15 million of ETH, for example. We had a recent whale step into the game for the first time. They bought $1 million of HEX and they staked it till May. And the price continued to rise from I want to say it was like 6.2 cents all the way up to was a 9-cent peak the other day. And this was all spurred by a combination of him making that market buy about 2 weeks ago, and then the stablecoin DPEG event that occurred a couple of days ago. So I know I'm throwing a lot of technical events and fundamental events that are happening on the economy, but that's what makes this such a more powerful transition now is you're basically seeing a flight to safety in HEX and something that can do mad returns and actually increase an Ethereum whale's position size or bag in Ethereum terms. I know currently HEX has done over like a 350% run up against Ethereum. So that means you would have effectively 4x'd your stack of Ethereum just by buying the bottom and letting the price do its job, which HEX is no stranger to doing this. It completely destroys the gains of Bitcoin and Ethereum. And this is why, volatility is something that you want to see in an asset while it's still in its nascent phase. This is just going on the 4th year of HEX. And then to counter this point whole with, looking at, why not the alternative of buying Bitcoin because it's more stable in terms of like, global mainstream acceptance. Well, there's a good point here, which is that, Bitcoin can be bought for 20 to 25,000 a coin, right? And I think it's like 24 or something. And you can buy set size. You could buy like, if you're super high net worth or institution, you can buy $10 million, $20 million, $100 million, and you can expect a 3x return over a 5-year time frame. That would be run for the par for the course for Bitcoin, and you'd have no problem getting that liquidity in and out. But you cannot get Bitcoin at sub $1 anymore. You cannot get Bitcoin at 8 cents. You cannot get Bitcoin at $10. And this is a function of the store value capacity of Bitcoin, both in its scarcity, its Bitcoin mining economy becoming increasingly more difficult to get new Bitcoins minted, its energy use, and HEX has a lot of these same functions in its store value backing in this economics package. That's the T-share rate. And so when a young investor comes into cryptocurrency, they're excited and they're seeing mad gains and they're inspired and ready to learn about the economics of these systems. It's hard to get someone that's not interested in economics to be interested in it. But when you couple that with 100x returns or 1000x returns, it's a really good motivator for people to step out of their comfort zone and start to learn about economics. So this is how the whole Bitcoin initiative started originally, and how this grassroots movement went from a sub-dollar asset to a $60,000 asset class per unit. And HEX is now in the same point of its life cycle. And so understand if Bitcoin is a master class in economics for somebody who's generally closed off to it, HEX is like the ultra elite super giga brain master class. And everyone that's in this community, I wouldn't say all of the users, but generally our users in HEX are way more advanced in the terms of crypto economics than your typical even Bitcoiner these days. Because the Bitcoiners getting in these days are just, if they're retail level, they probably are following the herd at this point. The mad gains for the retail investor and the community and drive and all these things are going to be in the thing that's going to run the hardest, the fastest, and give the most long-term prosperity. And HEX is already proving that. It's got this long track record now, 3+ years of flawless operation. It's got the immutable code beneath it, which runs this inflation model that's based on this thing called the T-share. And so diving into this information, getting one-on-one consultations with people that can know the system and give you the information you need can fast track you to understanding these things. If your goal is to purchase something in $10,000 hits or $20,000 hits at these prices, or even $100,000 hits, and only incur maybe 3 to 5% slippage on your position, some short-term volatility as you're entering the market on a 4-hour to 24-hour basis with your buys, and then you can accumulate a meaningful position, right? Create more scarcity of the object on market, and then watch this thing go up, and then start to earn a consistent yield on a shorter time frame. Because the whole basis of this system is you lock up your money for a certain period of time and you get a consistent return in HEX. Now, at Funding Gym, you've been in the system for a long time. You've seen how amazing it is. The first time I ever staked, you tell me what you think. The first time I ever staked and saw the little green message at the top says, you just staked, you staked your HEX, blah, blah, blah. I felt the sigh of relief knowing that I was guaranteed a return in HEX. And I was confident in knowing that this T-share system, this economics model that was the foundation of it, was going to be there forever, and it was going to guarantee me those returns, and that it was only a matter of time and adoption that was going to take the price to targets that were very, very meaningful for the people getting in at that time frame.
Yeah, there's a lot to unpack there. Part of it is the origin story as far as the reference of Bitcoin and the pioneers that I still pay respect to as far as the quote unquote OGs, whether it's Roger Ver or Gavin Wood or people Simon Dixon and things like that have made content and contact with traditional finance rails. So like on one side, it is kind of a replay of the origin of a new idea, the HEX contract, the HEX protocol that has this HEX on HEX on-chain return option is very interesting. Obviously, because I've been involved with the community for so many years now, I know that ROI. And yet the people that have started this reference that you're talking about, as far as like the life cycle, that HEX currently, like you're saying, $1 of Bitcoin later becoming in the high $60,000 reference as far as this chart. You can look at that and say, here is how similar HEX is in protocol to Bitcoin. This is how it has its security model and its social consensus and its support in code that it should have a financial ROI. Like the concept that I understand from 2008, when I was not there, 2008, 9, 10, and the origin story of Bitcoin was a peer-to-peer cash narrative. And it wasn't a speculative game for the early advocates of Bitcoin. It was, here is a form of currency that does not have the same central authority rules. It has algorithm and code rules about being able to send and receive. That's the story there. But human nature takes over when it comes to, why do you put your energy, your innovation, your brand, your speculative funds, your very limited resource of time toward anything? Why do you do anything over human existence? It is because you're looking for return, you're looking for yield, you're looking for ROI, right? So you become a better farmer when you learn how to irrigate or how to plant instead of how to forage. You become a better builder as far as construction of things and invention of things, because you see return on your time that's greater than your labor to construct, or your simple time investment of creating the thing. So I think that narrative has been missed by the Bitcoin and even the Ethereum plank owners or originators or early founders or early participants. I think that has been lost in a lot of ways. And now it is really in a defend the moat, defend the fortress of value that they have accrued. So like, I love the competition in the space to deliver better user experience, better ROI opportunity, things like that. When it comes to Ethereum's network, when you're talking about high net worth people inside of Bitcoin, they are very, very limited in their position, because like you said, the participant that learns about Bitcoin today is limited on their ROI potential. And they probably don't have, since they are new to the space, the exit route understanding. Whenever I talk to significant representatives of the maxi position of Bitcoin, such as Simon Dixon or others, they've been around 10, 11 years. They've been dealing with banking institutions and governments for quite some time to create the value of Bitcoin, to create the narrative of Bitcoin as a store of value or as a ability to transact, in banking turbulence. That is their position publicly. And they do talk about the code or the defense or the security model of the protocol. However, that is not how they act in their search for ROI. They search for ROI by taking a loan against their Bitcoin into finance, into dollars or yen or euro, and then using that energy, that finance energy of leverage and collateral to basically create other platforms that generate them yield, which is bringing new users into the crypto space, which almost always are trading on a central exchange or a leverage platform that relieves them of their keys. So it is a little bit like do what I say instead of do what I do kind of narrative from a lot of the ones that are at least public on Twitter and YouTube and content like that. So I like the thing that you said about you engage with the contract of HEX, you see the little green indicator that now you're staked, and that staking is not beholden to the ROI or even the increase in participants in the system, in the protocol. Doesn't have that as a requirement to deliver HEX on HEX return. You can see it in the code. You can see it in the execution as far as other others that may choose to self-dox on their return. And it's interesting that you just said something about, the quote unquote whale or the participant that I think had put in around $37,000 worth of economic energy at the time in 2019 and staked for a period of time, to where when they ended their stake and had their yield by protocol, they were able to exit around $12 million, right? Now, if that person that took that position and had that yield and that multiple were advocating the same strength, and maybe they are somebody that we know. It's pseudo anonymous when it comes to crypto returns. But it's interesting to see that the loudest message in the space is Bitcoin and Ethereum and all these other things, and our voice is growing because you see reference to not just the trappings of materialist experiences like fancy clothing and cars, but you're starting to see that institution or people that care about like long-term hold. They, like myself, I rotate into real estate for 2 or 3 years, and then I participate in cryptocurrency. And that's just a pivot because I used to do the same thing when it came to startup venture capital. I would take the risk, 8 out of 9 things would fail. The 9th thing would have a significant enough ROI that I would exit out of a position and buy real estate that had cash flow, and then rotate, basically. So it's the same sort of narrative about people that are looking for what is the return on your time, your brand, your financial energy, your advocacy, and the what you're looking for most is that code is infallible. That it is the harm is that the technology is not going to do you wrong. As long as that is sound, it effectively becomes sound money to me. So yeah, it's an interesting narrative about like the retail participant looking for mad gains and the pseudo degeneracy of, I'm just going to pull a lottery ticket and see what happens, versus the actual advocation as a monetary system or a monetary ROI is a pivot.
Mm-hmm. And comparing this to, because like a lot of our institutional investors, they're looking at Bitcoin as like, okay, I can bring in $10 million and I can watch that thing turn into 40 or $50 million over a 5-year time frame. And that's like good in theory. And then it's not wrong to think that way. And then there's probably a huge opportunity there. But with these store of value cryptocurrencies, when they do finally make floors, those floors are then never seen again. And so if you were able to see the early days of Bitcoin and correlate that with the early days of HEX, you're literally seeing the same thing, but at a magnitude more powerful. And it's due to the inflation rate and how that comes out on a consistent basis, and how the code can't be changed, and it's immutable. And when you throw in this new dynamic of a new blockchain, layer 1 blockchain coming to support the HEX ecosystem, it makes it even that much more powerful and exciting, because PulseChain is going to come along and solve a lot of the issues with gas, at least for like a 5 to 10 year window of time frame, and give so much opportunity for growth. And it's parallel to Ethereum, so that developers and coders that were good at Ethereum could build on that network, can now transport their contracts over to PulseChain and run them in the same way. It's the same code base, effectively. So you're going to have this like parallel lateral integration where the one thing that's going to tie these two networks together is HEX. And the reason why is because it's not unlike Bitcoin in the early days, where if you wanted to get exposure to Ethereum, if you wanted to get exposure to another coin, you had to go through the Bitcoin pair. And if you did not have Bitcoin on your exchange, you were not a relevant exchange. And so we're going to see the same thing now in the DeFi world, where HEX is like the economic powerhouse. And we can see that here. I'll pull up my screen on this ERC20 token tracker. If you exclude Tether and USDC, which are technically, unstable coins as of last weekend, you're seeing BNB in the #1 slot as far as an ERC20 on Ethereum, and then HEX in #4. So effectively, your top 2 true cryptocurrencies are BNB and HEX. And HEX's on-chain volume is 95% traded on-chain. And that's powerful because it's verifiable and you can track it. So if you go to economics, you can go here, and I encourage you as a new investor coming in to run this, look at transparent volume, and you'll see the coins that actually are fully traded on-chain that are backed by the other side of their trading pair 1-to-1. and that they can only be traded in and out of with liquid assets. You can't create paper HEX yet. And so that's powerful because you can see that it did $773 million of volume since the beginning of the year, and that 95% of that volume was traded on chain, whereas if you go back and just look at the top market cap coins, in the case of Ethereum, only 30% of that is traded on chain, and it traded 200 billion. So what is 30% of 200 billion? 200 times 0.3. So it's saying that, the second largest cryptocurrency on earth only traded roughly $60 billion verifiably on chain. And so that's, take it for what it's worth. These are still the two largest cryptocurrencies. They have an advantage over everything else in that they were the early movers and they did their thing first. But as we move forward through this and you're measuring things against each other in the top 100 or top 1,000 coins, I urge you to look at that transparency rating and see what kind of volumes those coins are pulling that have 90% plus. And just, it's going to be interesting to see how these play out. I think the thing to track here as far as an institutional investor is the volume ratio against the transparent volume, right? So how much volume are you getting over your time frame measured against how much of that is transparent, trackable, verifiable volume. So it's definitely a positive. And again, this is the number 4 token on the ERC20 standard, right? So if you're an ETH whale and you want to see price appreciation, you want to see ROI, you want to see a return in both, US dollar denominated fiat price appreciation, but also that you can get that hex on hex yield by staking hex, locking it up for any period of time. You're getting compound yield. You're getting compound yield in the form of price appreciation, and then also more returns in hex. And that when you do decide to put that money in and you put it away for 180 days, 2 years, 5 years, that yield's going to be consistent. And I saw a comment here. Someone said that they felt like hex was. He said different pitches work for different people. I personally see hex as a bank like the Fed with a fixed inflation rate, and all inflation goes to the bondholders. In a way, that's true. In reality, the inflation is dynamic, but such a small percent of the token is available for user supply that can actually affect the interest rate, so to speak, or that can affect that yield, that it's a pretty flat line and consistent. And so when you start measuring these things, like on hexcalc.net, you can actually measure the true value of the system. Like if price didn't even change from today's price and you staked a million hex, let's see, what's a million hex cost right now? It would be like $70,000, $77,000. This is a consistent yield of $8,000. And so what should be the draw for an institutional investor or a high net worth that's able to put in $50,000 or $100,000 into this asset is you're not really going to move the price too far against yourself buying that much at these prices, but you can still realize a 10x price appreciation. And that's important because, see, $100,000 gives you, let's see, for slippage here, not even a 0.35% slippage, okay? And you're paying a $32 gas fee. So if you're really thinking about this properly, you're probably going to be bringing in like 3, 4, 5, maybe 10 of these $100,000 buys over like a few day period to get exposure, and then that would net you like maybe 12 to 15 million hex. Just rough estimates based on your conditions that you need to meet. And then, like I was saying before, at current prices, assuming that this thing stayed flat forever, which we'll get up to the price chart in a second. I'm confident that it will go up, and we'll prove why that's a reality in a minute. But assuming price stayed flat on that $77,000 investment, you're looking at an $8,000 return in a 1-year time frame. So percent-wise, you're looking at 5.5%. That's better than even what the bond yields can give you. And the interest rate is not manipulable by any central authority in the same way, or it's highly unlikely that you'd ever see enough hex stake to really affect this kind of thing on a long enough time frame. And that's a function of, again, I'm getting pretty technical here, but it's important that you start to be exposed to this idea because otherwise you won't understand how this inflation model is built out. But the red line is how much hex it costs to get the yield locked in for yourself for your time frame, and the purple line is where the share rate's going to go, right? So, by this time next year, it's going to cost 32,000 hex or more to get a share. Today, it only costs 26,000 hex. So in a 1 year time frame, you might see like a 20% more expensive T-share in HEX terms, but we have to also account for the price movements in how high that those can go. As I said, just see that my screen's lagging a little bit, but here's the share rate again. There's the red line is the current share rate, and then over time you can see that this line goes up and to the right, meaning T-shares or the yield-bearing instrument, the bond, so to speak, is becoming more expensive over time as a function of people ending their stakes. So if somebody ends a stake and they saw a huge return, the system has to ratchet up the share cost so that they can't restake their principal plus their interest for the same amount of time and get the same amount of yield. And this is what ensures that you can't continually be a whale in the system and stake shorter and shorter and shorter and steal all the yield from everybody else. So it's a protection mechanism for both old users and new users, and it's a constant in the system. So because we have, for the first time in cryptocurrency, since Bitcoin's halvings, which is constant built into the code, this is the equivalent of that. It's halvings that are happening every time somebody ends a stake, except it's not cutting the inflation rate in half every 4 years. It's cutting the inflation rate down so that the guy that just ended his stake can't cheat the system, okay, and leaving meat on the bone for people forever. And then, so because this system works, it's flawless, and it's been working for 3 years, we've seen the price go up an insane amount. We've seen, just like Bitcoin here did, a crazy run up over a 15-year time frame. You saw it go from a penny to 69,000. HEX in the same way against Bitcoin is actually just, it's doing the same thing because of that inflation rate is calculable, immutable, and permanent. And if I pull up the daily here, oh man, I see my screen's not popping up fast enough. Yeah, something going on there. What do you see on the screen right now? Still the share rate? Can you hear me? Funding Jim? Probably muted. I'm going to switch over to my other sound.
Yeah, can you hear me now? I'm sorry.
Yeah, I can hear you. Is the voice coming across, or am I lagging?
No, it's all fine. Yeah, so here's the share rate on screen.
Yeah, I don't know why, but it's not kicking over. I don't know why it's just lagging. Let's pull up this other screen. Stop screen, pull up. Yeah, my screen sharing's a little slow, but my point that I'm getting to here for institutional investors is HEX is outperforming Bitcoin. And Bitcoin's like the gold standard of the highest appreciating asset of all time. And what gives these two systems similarity is that they're both stores of value. And what makes them stores of value is their scarce market supply and their scarce user supply. And that they become more difficult to obtain off market or from the contract over time. But yet, that's also what creates that volatility squeeze, which pushes price higher as a function of scarcity and on a world starved for yield, right? Still waiting on my screen to pop up. I don't know what's going on. I think like one of my favorite talking points here is, again, how that million HEX staked for 1 year can net you a 5.5% return. And in legacy finance terms, that's insane. Like to do the same in Bitcoin, you basically need to build out a multi-million-dollar mining facility and fill it up with computers, hire employees, pay for an internet connection, pay $50,000 a month power bills, and hope that at the end your net is more than 5.5%. And that's in the event that you're not in a bear market where price is retracing 75 to 85%, which happens every few years. So there's just a lot of variables there that you can't account for, and so much overhead. So if you're using Bitcoin and you're just buying it and holding it, it can be a solid strategy for turning big money into even bigger money. But to do it the right way is what was designed as a cryptocurrency. You're basically implying that you basically need to mine it. But in HEX, you don't have to do any of the overhead stuff. You can just buy the coin, lock it up, and see a return. And that return is going to be consistent. And when you get into a bull market scenario, the returns start to compound in your favor in an amazing way.
So when you talk about on-ramps, I like to talk about, because the biggest buy that I know of as far as a personal referral was 500,000 USD, and they went through Trust Token instead of a central exchange. I think it's because they wanted to participate less than 7 to 10 days as far as banking transactions and so forth. Do you have something, if you're talking to others that are, they play TD Waterhouse, they have brokerages, their family offices and things like that. Do you have anything that you recommend or that on your onboarding process when people are considering this kind of ROI?
Yeah. So right now, with where HEX is at in the market cycle, time is of the essence. And so then, because the pressure is on the buyer to get in and get exposure quickly, safely, and efficiently, there's a couple ways to go about this. I know we had talked before the stream about one of my favorite ways to on-ramp. It does have a high cost, but it also has a high speed and a high success rate. And that's like with like ramp.network, for example. It's one of these platforms where you can basically bring money in from a checking account and it gets immediately converted into Ethereum and deposited into your wallet. And from there, you can go execute the trade, or you can use USDC or ETH or DAI. You take your pick. And then it shows up in your wallet within minutes after the transaction's complete. And then you can swap it to get exposure into HEX. And when you're dealing with numbers like, I think the limit we saw was like $21,000 per buy. Maybe that's a little bit below your threshold, like what you want to get in. And so then I would actually turn people more to like what you're working with, which is UST, or wiring money into Coinbase and acquiring a USDC position or an Ethereum position with the intent to, get that money off the exchange and immediately get it into the asset of choice. In this case, it would be like HEX. And so those are some of probably like the best ways, like short term, like if you want to take on this ramp.network, if you want to get it in now, if you think the price is going to move quickly and you're willing to risk some fees, like I think on a $21,000 purchase on ramp.network, you're looking at $800 in fees, which is very, very hefty. But what you're basically making that bet on is buying the HEX before a move higher, right? And so we're in that kind of starting that parabolic move for HEX where the market supply is so thin that actually might be the way out for some people, to just get like a few big market buys in early to get that instant exposure, and then have your bulk of your money coming in on that 7 to 10 day time frame. How long did you say it was for UST from the wire point? It's pretty much immediate, isn't it?
Muted. First time you set up, it may be 2 days or something like that. As far as your KYC, AML, turn in your information just like you would for any central exchange or bank opening. But once they have that associated between your bank account verification and your MetaMask address that you're assigning, then that process is, I think it was only 2 days. It's been years now, but it was only 2 days for me. As far as what I remember. And then as far as if you actually are going to utilize it for onboard or offboard, if it's the same day before, I would say noon Eastern Standard Time, then the transaction in wire goes out, it gets processed, and then the same day within hours is an ERC20. Same thing with redemption. If it is during banking hours when they could actually process wire transfer receipt or actually issue out a wire transfer on redemption to your bank account, then burning the ERC20, sending it from your MetaMask to the burn address automatically is processed as a wire-generated wire transfer out, and then it usually receives the same day also in the morning, typically if you're going to onboard significant amount. It doesn't matter about the volume. I think they used to have a threshold when they were launched in 2017 that it wasn't really looking for retail, relatively low scale retail. I think they had a $10,000 minimum as far as the transfer in, transfer out. And that's because they're not percentage of the transfer as far as their fee service. They are a flat fee. And so it had to be a flat fee volume enough to make it worthwhile or something like that.
Do you know
now
they
come down to like under $1,000 or maybe under $500. But when they first launched, it used to be a threshold of 10 grand.
That seems like the play then. So, I mean, I would actually, Funding Gym's got this part figured out. If you're bringing in size, that's probably the way you want to take it. If you're a little bit smaller bags to start, or you need immediate exposure, you can get exposure in minutes with Ramp.network up to 20,000. You do take a hit on fees there as well. So maybe the play here would be to bring in your first initial exposure through Ramp on a small trade, and then bring in the big bag within a 2-day window or 3-day window after that, if you can be patient. And you can see the longer term prospect of the contract, and you need the time to really dig in and understand where the inflation model is and set and stuff. So I mean, it's going to take longer than 2 days to figure that out. So I mean, not digging at you, just take your time. To take the 2 or 3 days and bring in, if you're bringing in size. And then as far as like slippage on those orders, when you do get the ERC20 to drop in your wallet, whether it be USDC, DAI, or you're using ETH to trade into HEX, look at the slippage. So I'm going to bring up my screen now. Bam. HEX is looking good. Let's see here. Basic slippage I'm seeing on here is 0.5. For $100,000, you're going to take a 0.5% hit on USDC. Let's see what ETH side looks like. So it's a little bit more of a hit on the ETH. You'd take like a 0.75% hit. So you're looking at a 0.5 to 1% on a $100,000 market buy. And so then, you'd want to assess the chart and kind of see, what you think price can do short term. And when I look at the chart right now, I'm seeing like a potential for, there's an element here where it's hard to read the chart because we don't know what we're going to get in terms of hype running into testnet v3 for PulseChain. And the reason why that's relevant coming in now is because people are trying to secure their positions in anticipation of a fork. So in legacy world, this turns out to be like a stock split. So when Tesla was trading down and then they announced a stock split, there was actually a 50% run up on this. I don't know how big the asset class is now. It's hundreds of millions. It's just insane how big that stock is. And so when you're looking at a stock split in cryptocurrency in an asset class with insane volatility and huge price run-ups, like this is the first time we've actually had something come out where the underlying token to get exposure into it is going to be the key unit, like basically the Bitcoin 2.0 of exposure to get into this thing. And so we could see speculative targets, doubling or tripling or even quadrupling where the price is currently at right now. And so it makes like a lot of the TA not as important right now, because what I'm seeing as far as just simple supply and demand is, you have like on the ETH pair, HEX versus ETH, you're seeing 660 buys to 313 sells. So it's almost double buys to sells. And the guys that are taking profit right now, like I have somebody doing the chain analysis on the back end, and they're just seeing a lot of the selling coming into the market on this little tiny candle is just traders that are taking profit on each leg up. So each one of these spikes up in price, they're just taking profit and giving new whales a chance to buy the dip. And in this case here, in this particular candle here, there was a 1,000 ETH market buy that came in. It was about $1.6 million. And that one buy allowed the traders to come back in and get price up to a new high from 5.9 cents all the way up to 7.8 cents in just a couple days. These are daily candles. So in 4 days, it did a nice little move. I think it was like 45% or so. And so that's what's basically effectively happening here, is that each one of these pullbacks or bull flags, they're getting bought up. And so right now what we're doing in price is we're trying to catch support on this 1.0 level. And this is a key level. I mean, it goes back a few years, back to the beginning. You can see here, roughly at this point here, you're getting 8.5 cents. This was resistance here in the very beginning before the run up. We got above it, broke down, caught some support, chopped sideways, and then we had that PulseChain announcement, which took the price from 8.4 cents up to 20 cents and like I think it was like 2 days or 3 days. So we're basically back at that key level, and it was a key level here. It was a key level here, and now we're basically at that key level again. And so it's my belief that once we break this level, we can find support on what was a significant level last summer where we tried to rally off a low. We found some heavy resistance at 7.3 cents. We're basically just coming back down to do a double bottom or just try to find some support. This is an opportunity for large wallets, large institutional investors, large ETH Genesis guys, regular retail guys that were counting for 1 cent. They're all going to basically have to buy this new range. And you can see that in the liquidity pool here. Hopefully it pops up in short order. I'm not going to basically go into that till it pops up. There's some delay between when I switch my tabs and what you guys are seeing. I don't know why that's going on, but I apologize for that. Yeah, my screen share is not working today. Should have reset my browser before I got on with this. But so, I mean, the important thing here is that HEX is at key levels. Once 10 cents flips to support, I don't anticipate prices coming back below. If we don't get above it and hold it as support for a few days, then yeah, maybe we come back down to test these lower bands. Like I can see them, you guys can't see them, but there's a big wall of liquidity between 8 cents and 9.5 cents. And this is basically a chance for whales to accumulate this range. This is new liquidity that's been put here over the last couple days. Before that, there was no liquidity past 7.3 cents. So what this is telling me is that the market's starting to price in these higher prices, and they want to make fees in this new range, and they're putting their liquidity there, in support of that. And then behind price, there's not as much liquidity between, 5.8 cents and where the price currently sits, which means that the price can move more freely inside of that range between 5 and 7 cents. So we can get volatile in there if you do get spikes down. That's why price is being supported more easily inside of that range and being more holding and magnetizing to that 8 cent level right now. It's because the smallest little buys can push price, like just like a $50,000 buy can push price from 7.7, 7.6 cents right back up into 8 cent territory. And that's what we're seeing right now is that liquidity band is acting as a magnet, because sellers don't necessarily want to sell down $500,000 and incur so much slippage where there's not as much liquidity on the liquidity pair.
Like it. So everybody's curious about what the next cycle will hold. I think earliest on there was anti-government, cyberpunk, banks aren't going to screw us again in 2008 participants. Later, the pocket of money, that wasn't really the pocket of money people. That was just people that were anti-government. Then later, the first approach were the gold bugs and silver bugs, again, because their belief system of preparing for zombie apocalypse and anti-finance was a sound money narrative. And that was a pocket of money. People could convert some of their gold energy, their economic energy from gold into digital gold. And the Bitcoin people and the gold people got along. Then once that chart of adoption was exhausted, as far as that pool that was available to participate in Bitcoin price up, the newer things were other networks such as Ethereum and all the other Omnicoin and things like that were experimental outside of the Bitcoin culture or the sound money culture. So then it became startup. So the biggest pocket of money that was hit in 15, 16, 17 was basically startup culture, software culture. Again, the cyberpunk might be the origin. The first economic energy was people that had wealth in forms other than dollar accounts or banking ledger entries. They had it in quote unquote sound money of gold and silver hoarding. And then again, it returned to software is king, code is king. And now it is, they're somewhat aligned to say that you should have ability to transact and trade regardless of banking hours or border, with some exceptions that can still challenge you economically or restrictive, from governments and such. So what do you think that the next cycle is in narrative 2025? Is it a double down of the Bitcoin narrative, double down of the Cardano narrative, which is bank the unbanked and people that don't have economic freedoms for their their monthly wage? Now they can transact. Like, what do you think is the buzz of adoption for this coming cycle?
You're probably going to get layers of narrative. So there's going to be because there's starting to be this stratification between the investor classes of cryptocurrency now. So Bitcoin is going to be the institutional play to leverage a market where they can see 3 to 5x returns on millions and millions of dollars, or even billions of dollars. And so that's going to be more their playground. But a lot of that money is going to spill over into Ethereum and into the other altcoins. And so as far as like retail narrative, I really foresee a strong push towards excluding the pulse chain thing. You're going to see a narrative push toward AI. Like, I think AI tokens are going to just run on the premise of the success of ChatGPT and that whole notion that, AI is going to run the world. You're going to see just speculative run-ups on a lot of that. And I think you're right that sound money's been like a really good one in the past, and I think that's not going away, I guess, because we are going to see people. There's going to be obviously some sort of push for some kind of central banking coin. I'm of the belief that different factions of world governments are going to come together to create their own systems that are going to subvert the current SWIFT system, which is how transactions are processed globally. And so you might have competing nations team up to create their own separate financial systems. And so it'll end up becoming nation states competing for citizens in a world where this whole new class of people is becoming free and sovereign and international and global. And the sovereign cryptocurrencies, like your Bitcoins, your Ethereums, your HEXs, your pulse chains, and that's going to create so much wealth for so many people that's going to give them optionality to basically go wherever they want to go. And so I think there's going to be a narrative behind that that's going to basically, like, I think like your Cardanos and, the banking, the unbanked, I think that's already happening. I think even just simply with a Bitcoin, like in a third world country, you can plug in a Bitcoin miner and start earning dollars they're not their native currency, but they're meaningful there because their nation state currency is so hyperinflated that it's a form of prosperity if you can just even get a hold of an old 5-year-old Bitcoin miner there and start running that in your house somehow. And so I think that Bitcoin is rugging the old finance system and redistributing wealth amongst all of the nations. So it's giving certain level of sovereign power back that way. And I think that the cutting edge and bleeding edge of this whole movement is in the things that are going to pump the hardest and are going to have the most vertically integrated structures in them, which is why I'm very focused on the HEX and pulse chain thing. I really do believe that HEX is going to be the center of DeFi, and it's going to be the liquidity pair that bonds Ethereum to another layer one that can actually compete with it and have it all in-house. And so the narrative here would be faster, you've heard it already, faster chain, faster transactions, vertically integrated, optionality for people. You're even in the case of getting the stablecoin thing where, like, are these other layer ones going to have stable coins that are meaningful on them or not? It's kind of irrelevant, because I think we're headed toward a time when individuals are going to start to choose to transact in their native currencies that they see most fit. And we're going to start denominating the world over like a 10-year, 15-year period. We're going to start denominating the world in assets that we care about. It's almost like going back to barter, kind of like to trade like that, where I always thought Bitcoin, this is a parallel thought, I always thought that Bitcoin was going to become worth hundreds of thousands or millions of dollars, and it very well might, but that it was going to create stability. But I didn't anticipate that it was going to create volatility in the old world, because what is happening is, as cryptocurrency gets more stable, more accepted, and people denominate their worldviews in cryptocurrency, the old world becomes less stable, more devalued, purchasing power goes down even harder, and people abandon the old broken technology. And so I think we're at that cusp of a new world order of sovereign cryptocurrency being the optionality that we have to make returns immutably on chain. No one's going to tell you no. And we'll start to devalue going back into stable currencies. Not that you will stop seeing bear markets and bull markets and people won't shift to stables during certain periods of time, and they'll shift back into risk on cryptos during certain periods of time, because that'll definitely be here as a function of this long-term growth trend of crypto. But that you're just going to see a lot of different layers of narrative, because the reality is that crypto will end up becoming the stable, like, freedom fighting source of truth for people in the world. And then it's going to expose and shine light on all of the broken functions, just like what happened with these banks that failed last weekend and all this stablecoin depegging and these different events. So not a simple answer. It's a long, complex answer, and it's probably looking over a 10 to 15-year time frame. And it ultimately, your only chance as a regular person to see massive gain with relatively low effort and just, following this growth trend of like HEX, for example, and relying on the monetary policy and not relying on just strictly, it sounds crazy, but just not relying on just like price up, right? Because price up is probably the most important thing, but that's coming as a function of adoption now, because we've already gotten the price up in HEX, and so now you're going to see it accelerate due to network effect, Metcalfe's law, strong community, Lindy effect. But the monetary policy is what gives it value, and the fact that the yield is consistent, the same way that Bitcoin's mining economy is consistent. That consistency is the stability I'm talking about, that growth curve being predictable, and you can project it out and know it's going to be there in 5 years or 10 years. That's where you can really grab onto the chain and get pulled up, right? Is because there's something that's protecting you, and it's always going to be there. So I think it's up to us to kind of shed the narrative that we want, and all of these chains have a place. We're going to live in a multi-chain world. And really the other play besides AI is the layer zero, which is going to be the blockchains that come and they make all blockchains interoperable. And we're seeing that in all different forms. We're seeing it with Revolut, Ramp.network, Wire. There's all these different services that are coming along. They might have middlemen, but they're making transactions between legacy and crypto faster and better. And then inside of cryptocurrency, you're going to see an expansion of layer zeros, which basically connect all these chains together and allow for, like, even more efficient, safer bridging between different chains, and whole new technologies that just make this super highly frictionless and advanced. And it's really going to usher in like a whole new age of finance. And these protocols are going to take time to build out and mature, but that's the narrative, right? That's the way I see it playing out.
Yeah, there's interesting things that are coming around, whether it's wallet inside of a wallet like Internet Money IO, Brother KG, he's doing his thing as far as a wallet to do engage different blockchains. And like you said, layer zero, there might be protocol or different forms of ramp and things like that. But basically, that's kind of what I was getting at earlier, is if you have speculated in Bitcoin and you have basically created a wide enough moat and high enough walls to prevent building such things as stablecoins or on-chain dexes, that is at their peril, because someone that has speculated in Ethereum doesn't have to sell their Ethereum to have different exit routes of economic energy. They can do that now. They can do that through different protocols, whether they trust things like a Liquidity fork or Liquidity itself, which I guess is held up quite well during the instability of different fiat-backed stablecoins with all the banking turbulence recently, or the other history that has been assigned to the risk of an algorithmic stablecoin, such as was it Do Kwon and his stuff, whatever, right? So but that's design protocol versus some of these other things that are based on the L1 token itself or gas token itself. So yeah, there's just a lot of, all I was getting at is the ecosystem of Ethereum. And even with the tweets that Richard has been putting the past 5 or 6 hours was, what would be great decentralization is to have a second Ethereum, concentration of value, concentrate of a choke point, basically, that you have to interact only with Ethereum to call it decentralized. This narrative of forking the entire system state and making not just transaction cost or time, savings and things like that available for participants, but basically to horizontally scale. So like you're saying, you can go to different blockchains. There's different 0x kind of protocols to engage other blockchains and have economic energy move, from one system to another, or you can, basically participate in the franchising of Ethereum itself, the horizontal scaling of Ethereum itself through things like PulseChain or potentially PulseChain 2 and 3 and 4 in the future, different forks. So you have different exit routes and you have different things that don't necessarily harm your initial bag as far as brand or price performance, even though you get more participation in, Ethereum or the L1 of PulseChain and things like that tokens.
That's all great, man. I got to wrap this up, guys. I got another meeting I got to go to. I'd love to have you back on as soon as I can. I have some streams coming up next week that I'm already kind of booked out, but maybe 2 weeks from now because we only got to cover maybe like 30 or 40% of all the stuff that I really wanted to talk about as far as institutional adoption. I know we went at length on a lot of different topics. Some points we got technical, some points we went into the price. I think just a reminder to everybody, again, I'm working intently on helping produce a suite of institutional grade charting and analysis software by viewing the chain that can give us an in-depth look into good times to buy, sell, and understand the HEX contract from a whole 360-degree viewpoint. With Chris and from hexfire.io, Crypto Sloth, Silver the Antidote with the chain analysis. So be on the lookout for that. Another thing is next week or maybe next weekend, we're not sure, we haven't set a date, but we're going to be doing a market making course. When I say we, it's going to be me, Silver the Antidote, and Crypto Sloth will be putting together like a 2-day market making course. So if you want to learn about LP, I know there was somebody this morning that told me they did LP for the first time, and in the last 2 days they put up 100,000 HEX and saw a $1,200 return. So that was like meaningful for them because they were making over 10% in a couple days by setting liquidity. And now all of a sudden I'm seeing all this more liquidity. So people are starting to understand the power of selling the price up the chart. And that's something that your institutional investors need to know as well. So yeah, I got to get going, guys. Funding Jim, pleasure. Thank you for this is our first stream together, just the two of us. And you have so much great insight. You come from that world. You have so many good contacts. And so I can't wait to continue this into the future, man. Really appreciate it.
Sounds great, man. I'll talk to you soon. Have a good day.
All right. See you guys. Appreciate it.